Welcome back to the New York City Multifamily Podcast. I am Shaun, Riney, your host. Today I'm with my colleague and Brownstone, Brooklyn expert, Andrew Bronsteen. And our guest today is Greg Fournier, a man that many people want to hear from. Greg is the managing principal of Greenbrook Partners, privately held, vertically integrated real estate operating company, expertise in everything from investment management, property management, design, construction, the whole vertical integration, deployed over $1.5 billion of capital. Welcome to the show, Greg.
Yeah, thanks, Shaun. Good to be here.
So, for a lot of the audience, I know you don't do much press, so I appreciate you coming out here today.
Sure.
You recently completed a $486 million refinance with Freddie Mac on a portfolio of mid-rise apartment buildings. So that's where we are today. But I want to go back to the very beginning because I think a lot of people out there are aspiring to build a company such as yourself. Explain to us kind of how Greenbrook came to be, how many employees you have, just how do we arrive at February 2026?
And so we started really with a deal. Back in 2017, we found it. We closed in 2018, and it was a $10 million deal. We needed $5 million of equity. And we ended up calling everyone that we knew to come up with the $5 million. And so people were investing $50,000 to $500,000 in that deal. We ended up closing, renovating the apartments, releasing the apartments. And then 6 months later, we did it again and, pounded the phones to come up with another $5 million. And then the following year, we did it 10 times. Mm-hmm. And then the year after that, 33 times. And over the 3-year stretch, we evolved from, sourcing equity from our friends to middle market private equity. And we ended up with a programmatic partner the end of 2019, which really, catapulted the growth. And then we lined up a series of programmatic investors really to pursue 2 different strategies in Brooklyn: value add and then core. And so over the next 5 years, we ended up buying about 450 properties in total.
Yeah, it's incredible. And how many employees does Greenbrook currently have?
Yeah, so we're fully integrated. We do everything from acquisitions, asset management, leasing, construction. Everything is done in-house, and we have a team of 150 people.
Wow. And was there a certain, you went over your history quite fast, so I want to, still dive into a little bit. Was there certain points where, you really had to hire a lot and almost overhire in order to properly institutionally manage mid-rise apartment buildings? Because that's where I think the outside observer is always wondering. We have a lot of people that start out, it's like Andrew and Shaun leave, brokerage. They start out trying to buy buildings. But in the beginning, you can do everything because you're 2 people. Mm-hmm. But as soon as you hit this inflection point, you need to hire a lot more people. And if those properties aren't pouring out cash flow or have like a capital event, you kind of are in this in-between growth stage where you have to figure it out like you did. So were there those type of moments, and how did you overcome them?
Yeah, there were a lot. So we didn't make, I guess, taking a step back, neither myself nor my partner, Fred the Cow, we didn't come from any money, and so we bootstrapped everything. We didn't bring in an investor at the entity level. Whatever money we've made, we've reinvested in the building, hence the 150 employees. Mm-hmm. We, I guess over time, when you get to about 50 buildings is when things start to get a little
50 buildings. Got it. Okay.
Yeah. And so up until that point, we were doing, all of the sort of tactical things we were doing ourselves. And we probably had up to that point a team of 6-8 people, so we were really lean. Mm-hmm. And at or around 50 buildings is when, you can sense that the wheels might come off.
Right.
And so at that point, we really started to be mindful of reinvesting in the business, making strategic hires, setting up structure and systems so that we could scale. And, it was really trial by fire. So there was no silver bullet. Neither he nor I came from, management positions, mm-hmm. In real estate. It's a lot of small teams, 2 people find a deal, you source the capital, and then you collectively execute the business plan. But to do what we've done, which is really run this scattered site portfolio, I mean, it's a concentrated portfolio, but nonetheless, it's very labor intensive.
Right.
We needed people in place to make sure that, the trash is getting collected and that service requests are being handled and that, investor requests are also being handled. And so we did our best with what we could at the time to make smart hires and to train people and to kind of get them up the curve so that, we could continue scaling. And along the way, I mean, really just focusing on recruiting and retention, beyond just the money in the deal,
Right.
revenue.
Right.
But it's really team building and then making sure that the people that you hire are good managers, that they're resourceful, finding people who culturally fit that mold. It's challenging, but I mean, ultimately we ended up getting to a good spot. Like you said, we refinanced a $500 million facility with Invesco, with Freddie Mac around year end, and it's a testament to the team kind of coming together, executing at the asset level, but doing it at scale. So that refi was 260 properties, about half of the portfolio. And it was the reflection of, 3, 4, 5 years of rent growth that we've been able to achieve by providing the service to residents and by, trimming OpEx where we could without sacrificing the service to the residents.
Right. So take us, I'm glad you brought that up. Take us in the boardroom of that decision. I mean, one, I want to give you a lot of credit because, this collection of buildings, I mean, the knock on smaller mid-rise buildings, call it under 30 units is just, there's a lot of running around. You can't really always have a super in the building. So there's a lot of logistical effort that has to go into that. And the exits of institutional backing was kind of unclear when you were assembling these portfolios. But when you were assembling them, was this always the belief that if I build it, the institutional capital on the the refis and eventually the sales will be there, or did you kind of know ahead of time?
I don't think we realized the scale that it would end up at. I think if we did, we probably
bought more.
Yeah. Well, or like gone in a different direction.
Yeah.
Right. I mean, it's a lot of work.
Yeah. Now you're too deep into it now.
Yeah.
No hiding now.
So the strategy at the start, when we had bought the first couple of buildings, the first few that year, and then the next 10, what we were working toward was cobbling together a portfolio that you could clean up, stabilize, and then exit to an institution. We really didn't think beyond that. It was really that trade for the value add investors. And then, to the extent we could stay in the deal with the partner we would exit to would have been gravy. I'd say the strategy on day one was,
to make it super clean
level, and then do it enough times so that you could bring in an institutional partner.
And was the Freddie Mac option better than just a regular bank option because there's longer term IO, just a little bit better proceeds? I mean, again, they only lend on absolutely best in class, no problems whatsoever type buildings, which is why they usually don't lend on New York City real estate. So again, credit to you.
Which you've made an emphasis of buying these last few years.
The buildings, the location, the quality of the renovation, the way in which we operate, and it was done to the level that Freddie would come in and finance. And I mean, look, they weren't the highest proceed, but they were really competitive. I think we like the fact that, it demonstrates that we've institutionalized something that, historically, I don't think, it's not like regarded widespread as institutional. Right. So it checked a lot of the boxes, but I mean, candidly, there was demand from large private lenders, names everyone would recognize, money center banks, and the GSEs.
Oh, interesting.
So what was it that made you go with them?
Flexible terms.
It's not like we're at the peak of the market for this product either. I mean, we're in an elevated interest rate environment. It's probably another couple refis left, cycle wise. How do you decide what to? I mean, we've sold you some stuff that you've turned around and sold for major profits. 88 Fifth Avenue, 3.6 to 7.2 in a year. How do you decide what to refinance and what to sell? Is it just an IRR driven thing, or is it kind of what you determine just the best course to be that day?
Like I said, two strategies: value add with with one set of investors, and then core with the second set of investors, really one investor. And so generally our value add partners are return driven, and so they want to exit. 88 Fifth.
Yeah.
That deal we bought vacant. It was in severe disrepair. We renovated the units extensively, invested, hundreds of thousands of dollars in the apartments, and then leased them up, and then ended up selling them to our core partner.
Yeah, 7-2. That's a good trade.
Yeah.
I also, noticed, you typically get the rents higher than the pro forma that we sell the buildings at, which is, I don't know, I'd probably mistake on our end, but, I think you do efficient work. And, how important is it to have, enough units where you kind of know exactly the best layout and what rents the best? And I guess maybe a different question also is, are you seeing new trends in the rental market? Are people still wanting larger bedroom sizes and fewer bedrooms like in the post-COVID times, or are we back to heads and beds, just squeezing as many beds in?
So we've never really done the latter,
Okay.
heads and beds. I guess just taking a step back. So when you look at the portfolio, we're talking about thousands of units, hundreds of buildings, about 20 different neighborhoods within Brooklyn. And, so over the years, we've gotten good at organizing the data. Well, first collecting the data, organizing the data, synthesizing it, and then slicing it in such a way that you can use it to make decisions, smart decisions. And so things like migration patterns. So, when a tenant is applying for an apartment, are they moving from the West Village or from the West Coast or abroad? And then if they're moving within Brooklyn, are they leaving Brooklyn Heights for Bed-Stuy? So a lot of these trends, start to reveal themselves in the data, and you can see if, there's a push for 3 beds in Cobble Hill and Carroll Gardens, or 2 beds, or, like where the studios are in high demand.
Yeah.
And so it allows us to make better informed decisions. And so we have a look through into the rents, better than I think what you would see in Street Easy, or what, you're dropping into the depths.
You have your own Street Easy on your internal portfolio.
Yeah, we do.
What markets have surprised you recently in terms of rental numbers, and what markets have kind of disappointed?
So none of them have disappointed. And I mean, frankly, they've all surprised me. Looking back to, 18, 19, 2020, the rents that we were getting, that we would pro forma, I would tell you, I thought that those were aggressive. So, figure like 5,000 for a 3-bed back then. And now, I mean, you're clearing $8,000, $9,000, $10,000 for 3 beds in these neighborhoods. I mean, the finish level, as we've gotten better and more efficient on the renovations, so we've improved the quality of the renovations over time. We've been able to do things quicker.
Right.
So before, it might have taken us, 6 months, 9 months to get a building done. Now we can do it in 3 to 6. So we've improved on the execution there. But like back to the data on the renter, right? I mean, we're sending out renewals in New York 3 months in advance. And a lot of times those negotiations take the full 3 months before the tenant commits to leave or before they renew.
Right.
And so during those 3 months, you've got access to a lot of information that the market doesn't have. And so that's when we can, go all in on, Bushwick or Bed-Stuy, because we see people moving from, like Western Brooklyn to Eastern Brooklyn, or vice versa. So I think as we're underwriting these acquisition deals,
and that dictates where you're looking to buy the next ones.
I mean, we really like all of these neighborhoods because year over year, the rent growth has been spectacular just across the board.
Yeah, anywhere in Brooklyn.
I mean, the profile of the tenant sort of varies from Brooklyn Heights and Greenpoint to, Bushwick. But the reality is, there's no new supply in New York. So you've got, a fixed, essentially a fixed unit count, but it's a global city and people are moving to it each year. You get a new crop of renters, and the folks that are here are earning more money, or life circumstances change. And so they move, and so we can cater to whatever that the new demand is.
These brownstone Brooklyn neighborhoods, especially the A neighborhoods, I mean, you go on Street Easy, you cannot find, if you go on Street Easy right now and you look for a 3-bedroom in Cobble Hill or Carroll Gardens, there might be 6 listings total. And these are supply constrained markets with R6B, which is like basically contextual zoning where you can't build new. And there's a finite number of these blocks and streets. So it's hard to imagine that things ever go anywhere but north. I mean, unless it just becomes an undesirable place to live. Is there any one submarket, though, that you think is maybe the 2010 version of Williamsburg or is undervalued without sharing all your secrets?
I like Greenpoint.
Greenpoint.
Yeah. It's just north of Williamsburg. It feels like you can still get some value there. If you were, an individual and it's kind of a one-off, you can probably find something there. And I think there's room on the rents to run there because they still feel depressed relative to some of these other submarkets. They pop for sure, but they probably haven't popped, to the extent.
I'm with you. I told my wife she doesn't want to live anywhere off the L train, but I said if we were going to buy a brownstone or something, it's one of these tree-lined Greenpoint streets.
Yeah.
Any knock on the transportation is slowly getting figured out with e-bikes, the ferry. All of a sudden, Long Island City is connected to that north part of Greenpoint, which historically is far from the trains. And again, you're close to LaGuardia. One of the things we love about Brooklyn is you can get to LaGuardia in the airport in 10, 15 minutes. I mean, that's a great amenity to be in Queens or northern Brooklyn. The only historical knock has just been, G-Train and kind of a little bit more difficult to get to the lower part of Manhattan. But all of this is kind of getting worked out. The Greenpoint waterfront's blowing up. Sense. And I think these things that are selling for $1,000 a foot, even we're selling some like 2-3 families at $1,000 a foot. Who's to say those aren't $2,000 a foot West Village type prices on some of these like super beautiful streets? Yeah. Some of our other clients have picked Clinton Hill. Okay. They think that the price per square foot for some of these Clinton Hill brownstones that, we just sold you one on 39 Putnam, like $600 a foot, corner, garages, curb appeal, mid $2 million price point. Like it just seems like intrinsically cheap because it's kind of like more of like a Bed-Stuy price, but it's a Clinton Hill building. So I feel like those trades are very interesting.
Clinton Hill, year over year, between even just 24 and 25, there's a 40% bump in volume. The amount of deals that we're doing, and I would also like to point out, we've done for every deal that trades, we do 30%. Like last year, our market share was 30% in Clinton Hill. We're extremely active in Clinton Hill
nice
right
plug,
now.
Nice plug.
Thank you. If you have in Clinton Hill and you want a big price, call me.
Or just reach out to us.
Or just go to Greg.
Eliminate the middleman.
Battle of the mics.
But we're doing a lot there because the pricing is very achievable, and the new developments, transportation is easy. That's definitely West Bed-Stuy, Clinton Hill is a lot, and the deal we just sold you on 39 Putnam, great deal. Love that deal. What did you guys like about that one?
Location, good basis. We own a bunch of things right around there, within a stone's throw of it. So again, you've got a good look through into what the rents are, and then see you can, when property level cash flow, you can back into what you can pay. And I think we probably got a pretty good deal there. So thank you.
You're welcome.
You're welcome. That one sold for cheaper than the other two, and that was the corner.
For some context on that deal, we sold it for $2.6 million. It's 2 duplexes over a full retail on the ground floor corner with a garage, which is huge. $2.6 million for that on a corner.
2 garages. Really good part of. Have you ever thought about some of these higher end 10 unit and under buildings that the future exit could be a conversion to condominium, given the level of finishes that you're doing as a rental? We had explored doing a condo on a smaller walk up. The time it would have taken to get the approval, the amount of red tape, the cost, we ended up just deciding to go multi instead. We bought it for, I don't know, 600, and we ended up trading out for probably 1,200 a foot, which I think when we had pro forma condo exit, we might have been maybe 1,300. So for like an incremental difference, we could have gotten the condo exit pricing, but it would have taken over a year. And instead, we were done in 6 months. And so we've thought about doing it, but we haven't done it. Having said that, we've got a property management business, Freestone, and we manage condos and co-ops on behalf of third-party owners. So if you
live in a condo or a co-op and you want to swap out your management company, let us know. We would gladly take that.
Did not know that you did third-party management, so
Yeah.
I'm glad to bring that up. Yeah, I mean, it's an interesting, some people love real estate, but they just don't like managing tenants. So the condo angle is also very lucrative right now, and it seems to be on the up and up. Again, especially in these family-style kind of neighborhoods where there's not a lot of family-style rental product because no one builds large 12 to 1,500 square foot, apartments. So it's like those families, like they almost have to buy a condo, and I think it's also an interesting trade. Maybe somebody should test it, but like just doing a rental project, but with very large units. Like to me, it's 1,600 square feet. That's what a real family like minimally needs. 1,200 is still a little tight.
Yeah. What kind for the deal that you're thinking about going condo? What kind of additional, like how much more would you have had to spend to do the condos as opposed to just keep it as a highline rental? Was it a significant amount that changed the numbers, even though it was a higher sellout? Or
no, I mean these days the quality of the finish level that we put in is largely consistent with condo. I mean it's probably a notch below condo level finish. It's really time. So if you think about opportunity cost, if the apartments are getting 5,000 a month and you've got 5 of them, that's 5,000 per month. If you're going to be empty for a full year, so
that's a lot.
25 times 12, you've got financing in place, so then you've got the rate on your debt. So it can be significant. So it's not just the additional hard soft cost. Then there's the legal that's required to go into getting the approvals. So it's like twofold, right? You've got the direct cost, and then you've got the opportunity cost of having a building vacant for longer.
Right, that makes sense.
Although I will say, like if you just instead of going condo, you're just converting to a one family, you at least avoid the whole AG and the legal aspect. So that's another interesting bucket I see is especially if the brownstone rental, I call it an 8-family, 4-story brownstone, has some history of rent stabilization, mostly free market. But if it's vacant, just convert that to a 1-family and sell it. That's an interesting trade because it's discounted because of a couple rent stabilized, but like the building looks like a single family. Like it can be turned back into that without too much red tape, really.
In your on that, in your opinion, like you do multifamily, is the thought of like converting one of those buildings to a single family, is that like a different universe, or do you think like you could do it given everything that with the multi?
So in terms of the execution, it would be straightforward.
Really?
Right. Yeah. I mean, converting a 3-unit to a single unit, I think where the challenge is, or at least on paper, where you bump into them, is if your target on the rental is a couple who is earning, combined a few $100,000, 40 times the income is sort of standard. There are more of those people to populate the 3, 4, or 5 unit in the walk up that you would convert to single family than an individual who can drop $12 million bucks, on a single family in Brooklyn Heights.
Right.
So it's just the universe of buyers on the exit, I think, is smaller. And I mean, frankly, we've got the profitability is, similar to the scenario with the condo that we were thinking about doing versus the multi. The margin for us is probably going to be pretty consistent. And we live in a city where, housing is a significant issue. So if we can keep the unit count the same, the tenant demand is going to be there, and we're sort of giving back.
That actually kind of brings me back to something that I wanted to go back to. I think one thing that you guys do, I mean, you offer an essential service for New York City. Like you guys improve housing across the city and make unlivable homes livable and house families. You mentioned earlier, the culture of the team. Like one of the ways that you were able to scale the business is truly like through the culture of the team, bringing in the right people. I'm curious, what is, if you had to define your culture, what is it?
So we have really 3 core values. One is grit. One is frugality, or being resourceful. And then the third, I'm blanking on. So we may need to
frugality and cost efficient.
Yeah. So there's two. Yeah.
Yeah. So and it's just finding people who, that resonates with, because I mean, ultimately, anyone can spend $1 million on $1 million renovation, right? But what we're asking the team to do, and what their job is to do the $1 million renovation, but get it done for $100,000. So they really need to think creatively. They need to be cost conscious. They need to understand where they're investing and why they're investing in, XYZ versus, like gold fixtures. You know what I mean? And so finding people who
everything has to have a reason, and
like throughout the organization that that have a similar philosophy.
What part of the deal cycle do you get the most enjoyment out of? Is it signing the contract? Is it closing the deal? Is it finishing the renovation and signing a lease with a family that's just going to take it and is super excited about it?
What are the moments where Greg goes, nice?
Yeah, like where's the moment where all the other pain points disappear and you're like, it was the smiling.
I mean, it's finding the next one.
Yeah, Gaia.
Yeah.
It's typical New York City deal junkie.
The next one. Yeah, it wasn't the $400 million refi closing. It was
on to the next.
Yeah.
When you're looking at a deal, I'm just curious, and I know there's a lot of different factors, but what's the first thing that you look at when you see, a broker email? Is it location? Is it price per square foot? Is it, what's the first metric Greg cues in on to see if it's even worth another flintilla of his time?
You or want to make a plug for TJ?
Yeah.
You or TJ?
So
TJ Quinn, great guy.
Yeah, not to speak for TJ, but I think it starts with the location, and then within the location, understanding what the property level cash flow is going to be. So within the four walls that you're, potentially acquiring, what you can do with the space, and then what type of income that's going to generate. Because at the end of the day, we're fiduciaries and we're investing on behalf of high net worth, friends of ours, and so it's our responsibility to sort of do the math and be good at the long division. And, the math, you sort of triangulate to a number at the end of the day. And if we can pay, say, $650 a foot, we know with a high degree of certainty that the renovation is going to be $150 a foot. And so knowing based on the performance of the portfolio, rent in the submarket is $75 a foot. The operating expenses can be, also pretty consistent. That's probably $15 a foot. So you're $75 in rent a foot minus your $15 gets you $60. Your $650 a foot plus your $150 in renovation gets you $800 a foot all in.
Right.
Yeah.
So the 60 over the 800, if you do the math, it comes out to 7.5. And that's really what you're solving for, is a 7.5 yield on cost.
Gotcha. So anything that you're doing the work, it's got to solve to a 7.5 cap on cost, which is a great cap rate, especially when we're talking about the locations in New York City. Yeah. Before the show started, we were talking about just the overall national cap rates and how, most of my other, Marcus Mochep is all 50 states and Canada. And in most of these markets that you'd want to actually visit, the cap rates are still at neutral leverage. Like neutral leverage is kind of like the going rate. And in New York City, you're getting positive leverage day one, or maybe even building into a 7.5 cap on cost. Did you ever think about exploring? You mentioned you thought about exploring other markets, and then you kind of came right back to New York City. You're like, this is the best discount in the United States.
A couple years ago, saw what was happening in the Sun Belt. There had been a lot of capital that flowed into the Sun Belt, and then we had, rising rate environment. And so we felt like there could be a good opportunity because people likely overpaid. And then when the financing resets, there might be a good buying opportunity for us. And so we started looking selectively in a couple of geographies, and the cap rates were consistently, 5%, like to your point, neutral leverage. In some cases, it was negative, and so over that, 18-month stretch, things happened in New York, causing cap rates on these middle market deals to really blow out. So historically, things that were 4.5, 5 cap were now 6 cap, 6.5 cap. And so we just reallocated our time to focus more on middle market. So historically, we were predominantly focused on buildings that were 5 units or less. And over the last 6 months or so, we're sort of overweight focused on middle markets, a figure between 25 and 100 unit building.
And so now we're entering in, will you touch something or evaluate something that is what we call hybrid, like a partially free market, partially rent stabilized with good paperwork history, or does it need to be a 100% free market, 25 plus unit?
So I'd say predominantly fair market. So 80, 90% fair market, and the balance could be regulated, but we just need really good paperwork. IAIs well documented, construction contracts, receipts, like the whole nine, to demonstrate that the unit was legally deregulated.
What is your feeling? You might not have a perfect answer for this, but let's just say a building was deregulated, because we find this a lot in mom and pop Bronsteen, Brooklyn, especially the expensive neighborhoods, because the deregulation threshold way back when was $2,000 a month. I think people crossed over that $2,000 a month threshold back 15 years ago just through the turnover, and the DHCRs tell a story, but you might not have leases from 15 years ago. Does that fall into the bucket of this is pretty low risk, or do you absolutely have to have 20 years of paperwork that doesn't exist anymore?
You do.
Great. So
yeah, and I guess it really depends on the risk profile of the investor. So there might be some that are willing to go further up the risk curve, and I think for you've
already arrived, so you can take super low risk. But I do think that's an interesting point, because this is also part and parcel why some of the cap rates in New York City are higher, is because of this culture of political risk, whether it's real risk or whether it's just the perception of maybe risk. And I think a lot of the overcharge, type of re-regulation falls into that category, where every time I pull an actual large owner, I say, how many times is this actually happening to you where they're like reversing the rent? And very often it's like never, or if it ever comes up, the tenant just wants kind of a settlement, and we figure it out. And it's like, it's less than 1% of our portfolio. So it's kind of an interesting trade, because there's kind of like a K-shaped kind of, multifamily sector kind of going, where, the upper part of the K is the statutorily free market, stuff you can renovate core plus because it's easy to diligence and it's what 1031 and institutional capital wants. And then the other part of the K, where the cap rates are increasing, are these hybrids that they're all kind of lumped into the same bucket of paperwork, questions, but some are better than others. There's diamonds in the rough. There's, more risk. And I guess that's the space that you're looking to play in, because you're sensing that opportunity, but it's going to be, you got to have the staff to really go into that and not be lazy about it, which most buyers are.
That's a really good point that I want to ask about, is the number one thing for like us selling 8-unit buildings. The number one thing is people just don't want to deal with the diligence of even starting to look at the DHCRs. If you're talking about, 25 to 100 unit buildings, like you've scaled every single aspect of your business so far. How do you, I think personally, this is a phenomenal opportunity area to play in. How do you scale this new kind of bucket?
Well, it'll be easier. It's really hard running 455-ish unit buildings. That's why we have a team of 150 people. If we can buy one unit or one building with 100 units, you can do that with just a handful of people. But to your point, the challenge is, and for us, where we provide the expertise is on the regulation and on the compliance. You can't just parachute into New York City and expect to not get your face ripped off. You really need to know what you're doing beyond just being on the right side of the street, in the right neighborhood, on the right block.
Absolutely.
You've got to know, the state of play, with the political environment, with the regulatory environment, and just building compliance. it can drown someone.
Which you guys do a great job of. Like, whenever I talk deals with you and TJ, I literally learn stuff. Like, you guys are extremely diligent. That's one thing that sticks out about you guys. And now, if you take that, I guess it's just like you're going to now refocus personnel from more so you're going to be a little more selective with the buildings you're buying, because it's a bigger shot all at once. And so it's more diligence on the front end as well.
What about new development ground up? You obviously have the expertise for it. Is it just more of a the deal junkie in you doesn't wait 3 years to see something come to creation, or you just still find enough opportunity in the existing stock?
So I think it's both. The returns are there on, what is existing, and we can execute the business plan really quickly. So renovating a building in 3 months, 4 months, getting a tenant in within a month, and then exiting even inside of, 9, 12 months. So that the turn is quick and it becomes a bit of a flow business for us. On ground up, I think 3 years is probably ambitious, right? It could be a 5-year commitment, and when we first started buying buildings, we would find one we'd want to buy. I'd look over at Fred and I'd say, hey, do you want to spend the next year of your life working on this thing? And he would say yes. But, it's a different, ball game with development. Because it's a 5-year commitment. You see the frequency with which the regulatory environment changes in New York, and ultimately you buy when the land is cheap and you end up delivering when no one wants to buy the condo or whatever.
Timing.
Things change pretty quick these days in New York. And I think for us, the returns are there, even though there are a lot of people running around trying to buy buildings in New York and trying to put deals together, there's still a ton of inefficiencies, right? Last year we bought 53 buildings vacant, right? Like small vacant buildings in 20 neighborhoods, which will turn in a year. And then we'll bring, 200 units back online that were dormant and had been dormant for, in some cases, decades.
Yeah, bringing rents down. One other question on just, because I know you're in, institutional kind of capital world, since the refi, are you seeing like more institutional capital reaching out to you because they want to get in on the program? Like basically our cap rate's going to go down because this bucket of money is becoming even more and more comfortable with New York City, free market property. Like, are you kind of sensing that, more capital is flowing to this sector as we are in February 2026 compared to the last 2 years?
We get more inbounds now from traditional, real estate private equity than we have historically. I think part of it is, we've got the team of 150 people. We've got, 450 buildings and counting. And so we're better well known these days. And so that it could be a function of that. But I also think New York now, it's a bit of a contrarian bet. And if, you're a contrarian investor, it's a very good space to at least begin to try and figure out. And if you're going to, like I said earlier, like you've got to do it with someone who knows their way around the city. We've got a compliance team, and we've just invested a lot of money in creating an edge around these types of complexities to perform for the capital.
I love what you said about the inefficiencies of New York City market. For as much as we complain about all these complexities, that's what makes it fun, that like two identical buildings right next to each other could have two wildly different values. And like, that's like knowing the ways around that is the edge. It's just like there is so much difference between building to building. On one street, you could just walk up and down and be like, that could be worth 1.5, that could be worth 5, that could be worth 2.5. Like there's such a kaleidoscope of value propositions. And there are inefficiencies. I think one of the things that people just need to be able to roll up their sleeves in 2026. I'll give another example. We're selling a building, right now it's slipping into high violation counts. It might have even slipped into AEP. We were at the building this week, and it was very clear to us that the reason why the tenants were calling 311 is because they all speak Spanish. The super does not speak Spanish. Okay. The portal, the management portal that everyone has, right, isn't in Spanish. It's in English, and it's clunky. And people are actually paying rent in the building, but they're just calling 311 instead of calling the owner because they can't figure out how to communicate with the owner. Yeah. And so somebody from looking outside in at my broker setup is going to see, problematic building, yada, yada. This, I don't want to touch this. But in reality, if you just go there with probably a crew of carpenters and start knocking on doors, fix the stuff, like there's a way to turn it around. Yeah. And probably in all this regulated mess, there's a lot of those types of opportunities where if somebody comes in with a new balance sheet and a new new, fresh outlook and, management that speaks the language of the tenants, you can really right size these buildings from a low starting basis. So it's not what you're really looking to do, but it's just an example of like, go beyond the broker's OM.
Yeah.
Go beyond what it looks like on the surface level. Go walk the building, walk the street, and just be like, oh, this isn't so bad. Because sometimes you go to the building, you're like, not that bad. Yep. It's great. It's New York City. Let's buy it.
On that, because we just literally this morning signed a rep agreement on a building that is exactly that. You look at it online, looks terrible. You see it in person, beautiful. As brokers, I'm kind of asking you, like one thing that Shaun and I have talked about recently in selling these hybrid buildings is like, we've been quite frankly doing the same thing, trying to sell these buildings since 2019. And I think Shaun and I came to the agreement like recently that we need to kind of reframe how we're marketing these buildings, because literally the first question every person asks, and that you're going to ask when you buy these 25 to 100 unit buildings, is how's the paperwork? As brokers, how do we package this new listing or these hybrid buildings to you so you know that it's the paperwork on this is actually good, not there's no records of anything? What can we do to help you guys sift through the list?
Do buyers care if there's a preliminary report done by the seller, or are you just going to say it's done by the seller so it's worthless type of things? We're just basically trying to fast track, the common pain points.
The seller needs to do something.
Yeah.
Right. And so they've got to engage the attorney, and then they've got to demonstrate, why how the unit was deregulated. As a buyer, we're going to go and do the same thing.
Right.
So we have an army of lawyers that we use to evaluate these things. And to the extent it hasn't been deregulated, or, maybe there's some gray, just understanding within kind of a range, what the downside's going to be if it were regulated. Seller's got to spend a little bit of money to get that work done. And then serious buyers are going to be willing to spend the money too.
Yeah, that's a good point.
Yeah.
I want to wrap up with a couple rapid fire, closing questions. I'm very curious because you mentioned thick skin, earlier in the conversation. I think that's very important. You seem like a guy that is very centered on and results driven and very focused. Is there anything special that you do to block out the noise and just focus on the execution? Are you like a meditator, reader? How do you stay so zen? Or are you?
He's not zen. He's not.
No, I think I can be exceedingly patient to a point.
Okay, there you go.
And then I'm not.
Yeah.
I'm not a big fan of the multitask. I have always been really focused, singularly focused, and I think that's helpful. I pay very little attention to the noise, and it's worked to my advantage.
Is there any one publication that you make sure to read every day? One thing that you look at every morning?
Other than the BK Bronsteen newsletter.
Yeah, I'm sure he reads that. I'm sure he reads
it. It is good. I do read it. It's good.
He actually has complimented it.
Yeah, I do. The journal.
Sure. Yeah.
Yeah, the journal.
Check the treasuries.
Yep.
See what's going on.
Yeah. Throw on CNBC in the morning, read the journal.
Yeah.
It's balanced,
Anybody you look up to in real estate you're looking to emulate, or that you kind of always kind of looked up to?
Yeah. I mean, there are a lot of people. I worked for a large family office, not in terms of, manpower, but capital. And, for 6 or 7 years, it was like a revolving door of folks who were running large operating companies, private equity firms, real estate within private equity. And so I got exposure to, just kind of like the who's who of real estate. And the guys that are kind of top of mind, would be like Jeff Blau, John Gray, Barry Sternlicht, those types of folks.
Yeah, I'm with you. I mean, seems like, the higher you go, the more you are aware of people that just know how to they have the right information, they get the right information, but they know how to synthesize it quicker than the next person.
Yeah, and like technically they're really good.
Yeah.
Just they know the basics. It's not it's soundbite.
Well, I have no doubt that you might be in that category of the names you just mentioned. So we'll keep it short. Thanks for jumping on the show. I'm sure we'll do hopefully 10 more deals than we did last year with you, but Godspeed to you.
Yeah, thanks.
Thanks, Greg.
Thanks, Greg.
Bye.